Greetings viewers and welcome to yet another edition of the Empowered Consumer, brought to you by the Financial Services Regulatory Authority, where we talk about all issues in the financial sector. Today, as we celebrate the World Investor Week, I am sitting with Mr. Mthethwa from the Central Bank of Eswatini. Mr. Mthethwa, thank you so much for having us today. Can you introduce yourself and tell us what it is that you do?
Thank you so much for inviting me for this interview. My name is Mthethwa. I'm from the Central Bank, working under the Financial Markets Department. I'm the Deputy Director, Financial Markets, International and Domestic Markets. So the international markets, that's where we are managing the country's reserves to make sure that they are safe, liquid, and earn a reasonable income to sustain the bank. So on the domestic side, we assist government in raising funding in the local and international market, and also work towards monetary policy implementation. So that's the work of the department, and also assist government, particularly in raising the funding and also managing government debt.
Thanks, Mr. Mthethwa. This is exactly the kind of portfolio that we want to be talking to. You sound like you hold a wealth of information, and we are very excited to be having this conversation with you. Viewers, today we'll be talking about government bonds and treasury bills, and Mr. Mthethwa will be taking us through all the intricacies of how that comes about or how that works. So stay tuned. Don't go anywhere. Mr. Mthethwa, how can you define bonds, and what is the distinction between government bonds and treasury bills?
So the government bonds are government papers which are of a tenure which is more than 1 year. It could be a year, it could be up to say 40 years or more. And treasury bills are short-term instruments which are less than a year. So in Eswatini, we issue 4 papers. We have got 91 days paper, we have got 182 days paper, and 364 days paper. So why do we issue these papers? So government will issue this type of papers to assist her when it comes to recurrent expenditure, and also for long-term financing in terms of say, for example, infrastructure development for the economy. So the short end of the curve is mainly for recurrent expenditure, and the longer end is mainly for infrastructure projects, which could be, examples could be building of a road, hospital, and other investments of long-term nature, where government won't be able to finance them in a short period of time. So when it comes to bonds, so the bonds are there just to help government finance with short-term finances, and also help develop our local market through price discovery. Because you might find that some people are interested in short-term investments, so that's where they are able to invest in such papers. So if you want to defer your consumption, let's say you will need your money in 3 months' time, we are able to do so by investing those funds with government instead of consuming them prematurely or spending them anyhow when you find that you don't derive any value. So if you want to defer your consumption, say for 3 months, 12 months, you can do so and lend those funds to government. And government will be able to meet her recurrent expenditure and other finances. If you want to extend your, let's say you will need money after 10 years, so you can buy a government bond where you'll be able then you defer your consumption up to 10 years, and government will be able to now help finance their road infrastructure, will be able to finance schools and other infrastructure projects that are within the economy where government will require funding. So looking at the different papers, that is the treasury bills and treasury bonds. So those papers, they are used as a benchmark, particularly to potential investors who would want to raise funding in the local market. So the yield curve of the economy is developed or derived through the various tenures of government papers. So we've got the 3, we've got the 6, we've got the 9, and the 12 months. So for benchmark bonds, we have the 3 years, 5, 7, and 10 years. So whenever you derive that curve, so potential borrowers in the local market will then use those prices as a yardstick, then put a spread above that curve so that they're able to borrow as well from the local economy. So the reason why, these papers are issued, particularly the treasury bonds and the treasury bills, treasury bills are issued at a discount. So you pay less than the face value. You don't pay the face value of that particular security. So the interest is like it's prepaid instead of receiving interest at the end together with the principal. So you buy it at a discount. But for a bond, you can either buy it at a discount, which is less than the face value, or at par, which is similar to the face value, or at a premium, where you pay more than the face value. So I'll explain in each of these papers. Yeah, so looking at the treasury bill, I can make an example. Let's say you have got 100,000 which you want to invest. Currently, the rate that we have is 9.234%. So if you have invested at that rate, you will be getting an interest of 4,604.35 in Malangeni. So which means you are going to pay less than the 100. Then at maturity you are going to receive the 100,000 in Malangeni. Yes, but this type of securities for small investors, particularly the treasury bills, the minimum amount that you can invest is 10,000, and in multiples of 10,000.
Oh, I see.
Yeah, you cannot buy
the period that I have committed to.
Yes, you cannot buy 15,000 or whatsoever. So you can only buy 10, 20, 30. But what you are going to pay is less than the face value, depending on where the market is at that point in time. Because if you are a small investor, you buy from a minimum of 10,000, as I've alluded earlier. But as big investors will buy up to, say, from a minimum of 5 million, and in multiples of that 5 million. So those are the price determinants, because they are the ones who indicate how much they will be borrowing government, the rate. So as a non-competitive bidder who buys at a minimum of 10,000, you only receive the weighted average of those bids that have been accepted when the competitive bidders were bidding.
Impressive. Mr. Mthethwa, I heard you speak of specific periods, 3 months, 6 months, and so on. It sounds like there are specific fixed terms for both government bonds and treasury bills. What happens in the event that an investor, midway through whatever period they had committed to, needs access to their monies? What then happens in a situation like that?
Okay, yeah. Just in case an investor wants to redeem prior to maturity, they can either use the 4 banks, which are known as primary dealers, to disinvest there. But if you fail to get a price from those banks, the central banks then act as a lender, sort of like a buyer of last resort.
Sure.
So they will come to the central bank will then discount the paper for you, looking at the prevailing rate. Then you are able to disinvest.
Okay.
Yes.
So they do have the option of disinvesting. Are there any implications attached to that disinvestment, considering that an investor or myself did not reach the maturity stage of their investment?
Okay, when it comes to treasury bills, it's not that much of a problem. The challenge will be when you have purchased a bond.
Okay.
as I've already alluded earlier, that a bond can be purchased at a discount, at par or at a premium. So if you are buying that bond at a discount, it means you'll be paying less than the face value. And if you buy at par, it means you are buying at the face value of the bond. And at a premium, you are paying more than the value of that premium. So let's say, for example, you bought that bond. I'll make two scenarios because at par there's nothing much that changes. I'll make two scenarios where you buy at a discount. Let's say the bond you are buying 10,000. You're buying 10,000 emalangeni. If you buy 10,000 emalangeni, then let's say it's a 3-year bond paying a coupon of 8% for the 3 years. Then after say 2 years or 1.5 or even 6 months or 3 months before the bond matures. Let's say you bought it at a discount. I'll make an example. Say you paid 9,800 instead of the 10,000, which means you got a discount of 200.
Yes.
Then interest rates move up. So if interest rates move up, the bond price will move on the downward direction. So if you sell there, depending on where the yield will be, you'll find that you go to the market. By the time you sell your bond, you might realize maybe a small interest or even a loss, because there's something that is known as capital gains and losses. Let's say you buy that bond at a premium, which means you are paying more than the 10,000. Let's say you'll be paying 10,200, for example, because I was just 10,200. So your coupon would be paid based on the nominal value, which is the face value, although we have paid 10,200. Then interest rates, let's say they move up again. So you'll find yourself selling at a loss. You will be losing. You paid more for the bond when you purchased, and you are also now want to sell. Then you have that capital loss, depending on the number of days that before the coupon payment. So that loss might be reduced by the number of days before the coupon payment, because that accrued interest could be paid to you.
Yeah.
So in short, you can either benefit or lose, depending on the direction of interest rates. So if you move premature, that's the only risk. But for bonds, the good thing is that it's unlike the T-bill. The minimum amount is 10,000, and in multiples of 1,000, you can buy a bond for 11, 12, 13, like that. And for competitive bidders, the minimum amount is 1 million instead of the 5 million when it comes to treasury bills. Yes.
I see us having lots of future conversations,
Yeah.
because I also want to understand how to follow the markets so we make the right decisions. Mr. Mthethwa, can you talk to us about purchasing either of the two, be it government bonds or treasury bills? What are the requirements for one to acquire those, including documentation, etc.? How does one get to acquire those?
Okay, yeah, there's a form that you have to fill. For treasury bills, individuals are allowed to come direct to the central bank. So there's a form that we can fill. The minimum amount will be 10,000 malangeni, then in multiples of 10, as I've already indicated. So there's a form that you have to fill, showing the source of fund. You have to show the source of fund, your identity, proof of residence, all information on the sources of your income. So we want that information, also passport size photo and your identity, so that at least we know proof of residence and all those items as required in the banking sector.
Sure.
So we
our
need all
basic KYC details.
Yeah, KYC
Plus my
details.
passport photo.
Yes, yeah. So if we are coming with more than 10,000 as an individual, we will then use this electronic funds transfer. Then you prove that you have created that amount. But for small investors, like the non-competitive bidders, we would like to receive the funds prior to the settlement date, because there's no way we can find you once the auction is complete. So you pay in advance. Then on the settlement day, which is trade date plus 2 days, you come and collect your discount. Like for example, if you have invested say 100,000 at a rate of 9.234, so you'll come and get your 4,604.35. You'll come and collect those funds with the Central Bank. But if the funds are more than 10,000, then your funds will be deposited direct to your bank account. So the minimum amount that you can be able to deposit with the Central Bank or withdraw from the Central Bank is 10,000. So there's something I want to add here, particularly as I alluded earlier, that we also involved in debt management, particularly when it comes to government borrowing. We don't want government to be highly indebted in such a way that they will fail to repay. So the debt is contained, so it's a certain percentage of the GDP. So what you produce in the whole economy should also be able to sustain you to be able to repay the debt. So in the case of these papers, as I indicated, we pay when the discount, you have to take it. The coupon that we pay, you cannot be able to reinvest it, because government debt has to remain at that level. So we don't put interest on interest. So for someone who's looking at government paper, they'll say, I'll just roll it over and take it after 10 years. So every 6 months, if it's a government paper, a government bond, we pay you the coupon. So the coupon is paid in arrears. Whereas for treasury bills, the discount is paid in advance, prepaid. You get it earlier, then at maturity you get the face value.
Okay, I see. And so recently, and I'm going to read this one, recently there was a wide circulation in print and social media with regards to the income tax bill, touching on withholding tax. So what are the tax implications when one has invested in treasury bills and bonds?
Okay, in the case of Eswatini, because we want to stimulate market activity, and you know that taxes usually distort even the calculation of such instruments, it becomes so complicated. So there's no withholding tax on the papers for government that we issue, but it's up to the investor to make good to the taxman at the end of the financial year on any interest income that they've earned over the year. But as a government agent, we don't take withholding tax.
And you have touched on a few of maybe what would be advantages of investing in government bonds and treasury bills, but are there any other advantages towards investing in this particular space that you can tell us about maybe?
So the main advantage when it comes to government paper is that a government is considered risk-free, although there are some risks given what we saw in 2008 during the subprime. But they are very minimal when it comes to government, because government has got various sources of avenues where they can be able to source funding to make good of those obligations. So they can, because taxes are at the disposal of government. Government can decide maybe to increase taxes, but as a last resort, which we don't encourage, would be then government printing money, which is not encouraged at all. But we don't anticipate such, because we make sure that government debt or obligations are within her means in terms of GDP growth and production of the economy.
Sure.
Yes.
So I suppose it might, to this question, it might also depend on the fixed period that one would have signed up for. But how frequently does or can one expect to get interest on either of the two platforms, be it the government bonds or the treasury bills?
Okay, for treasury bills, because we issue those papers on a weekly basis. So on a weekly basis, we usually have two papers, but on a monthly basis, just 3 papers. So the 91 days paper is always there. So every week there's a 91-day paper, and the 182 and the 273 days papers, they alternate. So if this week there's a 182, the following week there's 273 days paper. And month end, we have got the 91 days paper, 182 and 364 days paper. Yes, so we make sure that every week there is a paper. So anyone who wants to buy the government paper can tap into the market at any point in time. And when it comes to government bonds, we issue bonds on a quarterly basis. So we tap into the market with the various tenures, but the benchmark tenures are the 3, 5, 7, and 10 years. So every quarter we do have those papers available. So I don't know if I'm missing something in terms of your question.
Oh, no, you've captured everything and more, like you
Okay.
did with all the other questions, actually. Mr. Mthethwa, I definitely want to continue this conversation. For this particular episode, I think that our time is up, but I see us coming back and knocking on your doors to have more questions answered. I'm sure our viewers have questions, which we are happy to take via any of our social media platforms. Just DM us any of your questions, and we might try and find our way back here in Mr. Mthethwa's chambers, where he can tell us more about investments and making good of our monies, and making financially savvy decisions. Mr. Mthethwa, thank you so much for joining us today. Thank you for taking the time out to talk to us and to talk to the viewers who are watching us. We really appreciate the wealth of knowledge that you have shared with us. So, viewers, if you didn't know, now you know.
No, thank you so much, and thanks for believing in me. I hope we'll be able to meet in future, and I think we are always open to assist, particularly Eswatini, because we are here to assist Eswatini and make sure that the economy is doing quite well, to make sure that investors are able to generate the alpha that they want, and also make sure that the market develops, because one of the objectives is to create activity in the domestic market. Like the yield that I was talking about, it stimulates activity in the local market through price discovery, because someone who will want to issue a paper in the local market as a potential borrower wouldn't know where to price that instrument. But because already government paper is in place, then they will be able to price, then add a spread above government paper, because government is less riskier than any other entity in all countries of the world. So government is less riskier than any company, because government has got so many avenues to source funding. They can borrow internationally, they can also increase taxes and use other means to make sure that they meet their obligations. Thank you.
Thank you so much, Mr. Mthethwa. We are indeed empowered consumers just from this conversation. Thank you once again to Mr. Mthethwa and to the Central Bank of Eswatini. Thank you to FSRA for delivering this episode of the Empowered Consumer podcast to us all. Ladies and gentlemen, we are celebrating World Investor Week. Stay empowered. Thank you.